This chart shows why investors turned cautious on Nike. Revenue climbed for years, but after peaking around 2023, growth slowed and even declined. More importantly, EBITDA dropped sharply from its 2020 peak, meaning Nike is earning much less profit from its sales. When revenue and profits diverge like this, it usually signals margin pressure, discounting, higher costs, and inventory issues. So the key question is simple: is this temporary, or is Nike entering a lower margin era? In the next slide, we'll break down what caused the decline and what needs to improve. Now let's break down what likely drove the gap between Nike's revenue and EBITDA. The biggest factor is inventory and discounting. When inventory builds up, Nike and its retail partners often need to clear product through promotions. That reduces pricing power and compresses margins very quickly. Another key driver is higher costs. Even if freight and input costs normalize over time, periods of elevated logistics, labor, and manufacturing costs can hit profitability, especially when the company is also discounting. Third, there is the channel mix effect. Nike's direct-to-consumer model tends to deliver higher margins, while wholesale is lower margin. If the mix shifts toward wholesale or if DTC growth slows, overall profitability can decline even if revenue looks stable. We also have weaker demand in some key categories and regions. When consumer spending slows or competition intensifies, Nike may face lower full-price sell-through, again pushing the company toward more promotions. Finally, Nike has global exposure, so currency moves and macro volatility can create additional pressure on reported results. In the next slide, we'll shift to the bull case: what could improve from here and where the opportunity might be if margins stabilize. Now let's focus on the opportunity side: what could improve for Nike from here? The biggest upside driver is margin recovery. If discounting eases and pricing normalizes, profitability can rebound faster than revenue. That's why EBITDA matters so much in this story. Closely related is inventory normalization. As inventories return to healthier levels, Nike can reduce promotions, protect brand value, and move back toward full-price selling, supporting both margins and earnings. Nike also benefits from product innovation and premiumization. New footwear platforms, performance technology, and limited releases can help Nike maintain pricing power and strengthen brand demand. Another key opportunity is a rebound in direct-to-consumer. If Nike accelerates growth in digital channels and improves the retail experience, it can rebuild the higher-margin DTC mix over time. Finally, Nike still has long-term growth runway in emerging markets, and also in specific segments like women's, running, and lifestyle categories, where the brand remains extremely strong. The big takeaway is this: Nike doesn't need explosive revenue growth to recover. If margins normalize and the channel mix improves, earnings can recover, and that's where the opportunity lies. Now let's look at Nike's valuation and what these numbers are really telling us. First, the 10-year annual return of only 2.5% is weak for a premium global brand. This reflects that investors have gone through long periods of high expectations, followed by valuation compression and profit pressure. At the moment, Nike looks expensive on earnings and cash flow. A PE of 38 and a price to free cash flow near 39 are high for a company facing margin pressure and slower growth. This usually happens when the market is pricing in a recovery in profitability, or when current earnings are temporarily depressed, which makes the multiples look inflated. The EV to EBITDA multiple of 20 also signals that Nike is still valued like a high-quality, high-growth consumer brand, even though recent profitability has been weaker. So in short, the market is paying for the brand, not for the recent numbers. On the positive side, the balance sheet is strong. Net debt to EBITDA is only 0.6, which is very conservative. That gives Nike flexibility to invest, buy back shares, and navigate weak demand periods. However, ROIC at around 10% is currently not impressive for Nike. Historically, investors expect Nike to generate higher returns on capital. The lower ROIC is consistent with the margin compression and the need for discounting. Margins confirm the same story. A net income margin of 5.4% is low for Nike relative to its brand strength, while the gross margin at 41% remains solid but has not translated into strong bottom-line profitability recently. Nike is a high-quality company, but the valuation still assumes improvement. If margins recover, today's valuation can make more sense, but if profitability stays weak, the stock can remain expensive. Now let's cover the key risks for Nike looking into 2026 and beyond. The biggest risk is that margin recovery takes longer than expected. If Nike remains stuck in heavy promotions and discounting, profitability may stay compressed. and the valuation could remain difficult to justify. Another major risk is intensifying competition. Nike is facing strong momentum from competitors across multiple segments: performance running, lifestyle, and premium shoes. If competitors keep taking share, Nike may need to spend more on marketing or accept lower pricing power. Nike is also exposed to consumer spending pressure. In a weaker economic environment, discretionary spending can slow, and higher-priced athletic products become easier to postpone. China and global macro exposure remain important. Nike depends on international demand, and changes in China's consumer trends, geopolitics, or local competition can impact growth and investor sentiment. There is also brand and execution risk. Nike is a brand-driven company. If product launches miss, trends shift, or the brand loses momentum, sales and margins can weaken faster than investors expect. Finally, currency movements create FX volatility, which can pressure reported revenue and earnings even when underlying demand is stable. In the next slide, we'll look at the key mistakes and challenges Nike faced in the last 5 years, and how those factors contributed to the current situation. Before we wrap up, it's important to highlight the main mistakes and challenges Nike faced over the last 5 years, because they explain much of the recent pressure on margins and investor sentiment. One major issue was inventory buildup. When Nike carried too much inventory, it was forced into heavier discounting to clear products. That hurt pricing power and damaged profitability, even when revenue didn't collapse. Another challenge was an over-reliance on classic franchises. Nike benefited for years from a few iconic product lines, but as consumer tastes shifted and competitors launched new platforms, Nike faced periods where innovation didn't translate into immediate growth. Nike also had execution issues in its direct-to-consumer strategy. DTC is a high-margin channel, but scaling it successfully requires strong demand planning, product allocation, and a smooth digital experience. Any missteps in this strategy can quickly hit margins and increase promotions. Supply chain disruptions and higher logistics costs also played a role, especially in the post-COVID period, increasing cost pressure at a time when Nike couldn't always raise prices without losing volume. Finally, Nike faced uneven regional performance, particularly around China, where demand trends and competitive dynamics were less predictable than investors expected. Nike's recent weakness wasn't caused by one single event. It was a combination of inventory issues, execution challenges, and shifting competition, all of which led to margin compression and a reset in expectations. You'll often see analysts split between hold and buy on Nike, and the logic is usually straightforward. The hold case is based on uncertainty and timing. Nike is clearly a high-quality company, but earnings and margins are still under pressure. Many analysts want to see proof of a turnaround first, like normalized inventory, less discounting, and improving profitability, before recommending aggressive buying. In other words, hold often means, great company but we're waiting for confirmation. The buy case focuses on long-term brand strength. Nike remains one of the strongest consumer brands in the world, with global scale, innovation capability, and pricing power over a full cycle. After a meaningful stock pullback, some analysts argue the market has already priced in a lot of bad news. Their view is that high-quality companies tend to recover, and if margins normalize, the upside can be meaningful from today's levels. So the difference is mostly about timing versus conviction. Hold investors want evidence of improvement. Buy investors are willing to invest earlier, expecting Nike to execute a turnaround. Let's wrap it up with Nike's dividend and the final investment takeaway. Nike currently offers a dividend yield of 2.55%, which is modest compared to classic income stocks. The payout ratio of 94% is relatively high, which suggests that dividends are less flexible in the short term while earnings are under pressure. That said, Nike's investment case is not built on dividend income. It's built on brand strength and a potential recovery in profitability. Nike remains a high-quality global company, but today's valuation still assumes improvement. If inventory levels normalize and discounting fades, margins can recover, and earnings could rebound meaningfully. But if margin pressure lasts longer, the stock can remain expensive and volatile. So Nike may fit best for long-term investors who believe in the brand and are willing to accept short-term uncertainty. Thank you for watching. If you enjoyed this analysis, please like the video and subscribe for more long-term stock breakdowns. And let me know in the comments. Do you see Nike as an opportunity today, or would you wait for confirmation of a turnaround? This content is for educational purposes only and is not financial advice.